We're ready. Right. Can I welcome everyone to this meeting of the local pension board? It's the first one of 2022, so we're going to have plenty more coming through. But I'd like to welcome everyone for coming, and I think we shall start off with some introductions. And I think if it's all right, and as a way of checking the volumes and that people on Zoom can hear us, we shall start with David. If you could do your introductions.
Yes, good morning, everybody. My name is David Smith. I'm the Finance Director at Autism East Midlands, and I'm an employer's representative on the Local Government Pension Scheme Board.
And then John.
Hi, I'm John Rose and I'm advisor to the board. I was formerly Chief Finance Officer at London Borough, Waltham Forest.
Chairman, I'm Martin Gately from Democratic Services and I'm the Clerk to the Pensions Board.
Hi, I'm Kieran Guilfoyle. I work in the Pensions Investments team at the County Council.
Hi Chair, I'm John Clues. I'm the Pension Admin Manager.
Thanks Chair. Keith Palterman, the Group Manager for Financial Services at the County Council.
Mark Eppinstall, representing members from GMB.
Councillor Eric Kerry, I'm Chairman of the Pension Fund Committee. I'm just observing today, thank you.
Okay. And a special welcome to Councillor Kerry. And myself, I'm Tulani Malif, I'm the Chair of the Pension Board. And we shall start on straight going on to item 1, which is the minutes of the last meeting held on the 16th of December 2021. The paperwork has been sent out. Are we happy to accept the minutes as they are? Okay, thank you. Next item is apologies for absence. We got any apologies for absence?
Chairman, we do have 2 apologies. We have apologies from Councillor Sally Longford, who is on other City Council business, and also from Councillor Francis Purdue-Horan, which is for medical reasons. Thank you.
Thank you. The next item is item 3, which is the declaration of interest by members and officers. Do any members or officers present have any disclosable pecuniary interest to declare? No, I take it there's any. And do any members or officers present have any private interests, pecuniary or non-pecuniary, to declare? No, thank you. We'll move on to the next item, which is item 4, which is the Pension Fund Annual Report and Accounts. This is to provide the board with information on the Nottinghamshire Pension Fund and accounts. Kieran, would you like to take us through the report?
Thank you, Chair. This report is to let members of the Pension Board know that the Pension Fund Annual Report for financial year 2021 is available on the Pension Fund website. In summary, the accounts of the fund show that the value as at March last year was just a little over £6.1 billion, and that was an increase of 21.7% on the previous year. During the course of the year, the return on all investments was 21.8%. Equities having the highest return of 38.4%, and property having the lowest return with a minus 4.9%. I think these extremes are as a natural result of a 2-year pandemic and lockdown. The external auditor, there's a section in there about the admin side, how the pension fund works as well, and the external auditors found no misstatements in the fund and gave an unqualified audit opinion, and it was presented at the fund's AGM in January. That's all. Thank you, Chair.
Okay, thank you. Have we got any questions on that? On the report, or are you all been stunned by how succinct it was?
I mean, I would observe that obviously the value of the closing assets has increased substantially year on year, and at some point, is that reflected anywhere in the actuarial report, dare I say, as regards to the ongoing liabilities and assets?
Okay.
So we're just about to undertake the triennial valuation of the pension fund. So the actuaries will be looking at the value at the 31st of March this year.
Yeah.
And we're using that alongside the liabilities of the fund to calculate employer contributions. So we're working very closely with Barnett Waddingham at the moment. And as soon as we have any information, we'll obviously share it with employers to let them know what the likely outcomes are going to be. Barnett Waddingham have done a presentation here, I think, just to give an indication of how the valuation process is undertaken. But the actual valuation will start in April.
Okay, thank you.
Any other questions? Because I've got a couple, which I take it that I can't see anybody. Just one, which I know we'll probably find out in September. But in terms of the fund value itself, how close are we to being fully funded?
Again, Chair, so that will be part of the valuation process. So we were 93% funded last time. We were in January when we first met the Barnett Waddingham. They were indicating that they expected funding to be nearly 100%. Obviously, the most recent stock market fluctuations may impact on that. So we would expect an increase, but we'll have to wait and see because it's a difficult balancing act between the asset valuations and the liability valuations. So we're certainly hoping to see it near 100%.
Okay. Thank you very much. Any further questions? Okay. Right. I formally move the recommendation on page 8, which is that the pension board members consider whether there are any actions they require in relation to the issues contained in the report. Do any members have any comments or questions? And can I have a seconder?
I'll second.
Thank you very much, David. Okay. Right. We will now move on to a vote. Is that agreed? Yep. Thank you very much. Do we have any votes against or abstentions? I can't see any. Right. It's been carried. Thank you. We'll move on to the next item. Item 5, which is the pooling update and a presentation by LGPS Central.
Thanks, Chair. So there's just a short covering report. There's a presentation due from LGPS Central Limited, our pooling company. So Colin Pratt and Lee White are here from the company and we'll be doing a presentation to the board. Thank you.
Thank you very much. Okay. All right. Good morning, gentlemen.
Good morning.
We're looking forward to your presentation. And if you could kindly introduce yourselves.
Certainly, will do. My name is Colin Pratt. I'm an investment director at LGPS Central. With me is Lee White, who's communications manager. I'm relatively old school from LGPS Central point of view. Been there nearly 4 years since inception, more or less. Lee's been there for 5 months. Lee's role today is really to he's relatively new to the company, so he's never been to committee meetings and various other things. I have been to lots of committee meetings in my time because prior to LGPS Central, I did 32 years at Leicestershire County Council Pension Fund, so probably the last 20 or so of those involved in committees. So that's our background.
Okay.
So in terms of how you want us to present, do you want us just to run through the presentation?
Yes, please.
I'm happy, if you want to ask any questions at any stage, I'm quite happy to take those. Don't feel that any questions are off board in any way, shape or form. If you want to ask a difficult question, we're quite happy to answer difficult questions. So in terms of the things that we really want to get across today, there's 3 things we really want to cover. First and foremost, why does pooling exist? Why did we move from a position just over 4 years ago where we had 89 individual local authority pension funds, all of whom appointed their own investment managers, to a position now where we're gradually moving towards a more centralised format of 8 pools. How pooling actually works is probably important to you. And hopefully what I'll leave you with is the view that the interests of LGPS Central and the interests of Nottinghamshire Pension Fund, and in fact all the other 7 pension funds that are part of LGPS Central, are absolutely aligned. We have no interest other than your interest. It's as simple as that. So in terms of the background, lots of people think pooling started in 2015. It actually didn't. What happened in 2013 is the person who was then the Minister for Communities, Housing and Local Government stood up at a local authority conference and effectively said, there's 89 local authority pension funds in England and Wales. You all do your own thing. None of you communicate with each other. None of you have any joint workings in terms of appointments of managers. And effectively, you're paying too much for the services that you're procuring. They're the investment management services. This caused absolute uproar within the 89 local authority pension funds, as you can imagine. I was at Leicestershire at the time, and believe you me, there was uproar. There was then a call for evidence, and the 89 funds all effectively said the same thing, which is, we recognise historically we haven't perhaps worked together as best we can do. We haven't cooperated on manager appointments to get the best fees that we can do out of, you know, the city, so to speak. But trust us, we'll do it better in the future. The government seemed to accept that, and things moved on. There were signs of joint working happening, but in 2015, when the Conservatives won an outright majority, the first speech that George Osborne gave as the Chancellor of a Conservative government included effectively the line that pooling within the local government pension scheme is going to happen. That was a shock to some people who thought it had all gone away. It then took effectively 3 years to get pooling up and running. The actual consultation in respect to pooling didn't happen until November 2015, so Osborne spoke in July 15. The consultation didn't happen until November. The government put forward a number of things in terms of the requirements. There had to be scale. So any pools that were formed had to have at least £25 billion worth of assets. The overall and key message was you have to make savings. Every penny that you pay in investment management fees is a penny that disappears from your pension fund, is a penny that the employing bodies have to put in. So it's absolutely key from that perspective, from a taxpayer's perspective, that we get value for money. Value for money is of course not just getting the cheapest, it's about getting the best return you can do from that perspective. Included good governance, and the slightly odd thing that was in there was to do with increasing infrastructure investment. Now, local authorities at this time had already started to invest quite heavily in infrastructure on a global basis, not necessarily just in the UK. But clearly that was a government aim. The government had a huge infrastructure project up and running. It wanted local authority pension funds to fund some of that. Local authority pension funds don't like being told where to invest their money. I think that's probably fair to say. They want to invest their money where they think the best opportunities are. That infrastructure died a death. Not that infrastructure investment died a death in any way, shape or form. Infrastructure investment has continued to grow, but the government didn't really get its way from that perspective. In February 2016, there were 8 submissions put forward to the government for pools. These are, there was no prescription as to how the pools were formed. Effectively, the funds got together amongst themselves and decided who they would partner with. Those pools were, the smallest one had 3 local authority pension funds in it. The biggest one, the London one, it's got, I believe it's 32. You can imagine the nightmare of trying to get 32 people to agree the same thing. Thankfully, we're not in London. Ours, LGPS Central, as became known, was 8 of us. Now, most of those 8 funds had actually done a project, funnily enough, which coincided almost exactly with George Osborne standing up in July 2015 to do some joint working. And what that showed to me, I was actively involved. What that showed to me is when you put forward a united front, investment managers are on the back foot. Investment managers make a lot of money. They're not doing it for no money whatsoever. The particular project became known as the 7 Shires, and it was for passive investment mandates. So there were 7 funds involved. We didn't call it 7 Shires, the press labelled it 7 Shires. 6 of those ended up in LGPS Central. The one that didn't was Warwickshire. That went off to one of the other pools. And effectively the thesis was, we've all got passively managed assets. They're split between 3 different managers. Why don't we get together, decide we're all going to put them with one manager and get the best fee that we possibly can do. And by creating that conflict of managers either having nothing or everything, fees came tumbling down. Passive fees were already cheap. I'll give you an example of Leicestershire. At Leicestershire, we were paying at the time 4 basis points for UK equities passive management. That's 0.04% per annum. We ended up paying 1.1 basis points from that. For some of the overseas assets, we were paying between 8 and 12 basis points. We ended up paying 1.8 basis points for that. Similar things happened across all the funds. To me, it was a moment that I'd never expected to happen. But it did show to me that pooling could work, particularly from a fee perspective. That thankfully has been borne out, actually gone live. The same sort of thing, not necessarily to that extent, but the same sort of fee saves occurred. When you put managers in a situation where they only now have 8 pools that they can say they'll service to, as opposed to 8 to 9 local authority pension funds, they either win or they lose. If they lose, they get no fees because they don't have any assets. Likewise, they probably don't get any fees for 3 to 5 years because that's the sort of turnover phase for an investment manager. So they want to be in on day one, and their fees have tumbled accordingly. So it has been, a huge eye-opener from my perspective, and pooling has worked. So in terms of what we actually do, we do exactly what the partner funds want us to do. We're not here to design products that nobody wants. We're not, as it is, a private sector investment company that decide what we think will sell to people and then try and sell it to them. The partner funds get together, decide what products they want, and then ask us to launch them. Launching them, by and large, means that we go out to the market, we select the best investment managers that we can do for that product to meet the requirements and get the best fees that we possibly can do. Again, it's not about getting the cheapest investment managers, it's about getting the best net return. But fees is part of that. I always say, performance is not guaranteed, but fees are. If you've got 2 managers who you think are equal, one's charging you more than the other, the answer's obvious. If you've got one manager you think's far better than somebody else, but is charging you a bit more, you'll take the more expensive manager because you think that you'll get a better net return from it. So that's what we do. We launch funds that we have been asked to launch by the partner funds. We get nothing for it. There's no bonuses or anything along those lines. Our interests are absolutely 100% aligned with the partner funds. We have a requirement to make fee savings. We have demonstrated that so far. I'll come on in a short while as to the savings we've made so far. And that will continue to happen going forward. We focus on the needs and expectations of the partner funds. Nothing more, nothing less. In terms of the resource that we have to make these things actually happen, on slide 4, we currently have 64 staff, £26.7 billion worth of assets under management. That will increase as time goes on. And I think the one in the middle there, the 100% responsible investment is key to what we do. The partner funds have made it absolutely clear that they believe responsible investment adds value in terms of investment returns. Responsible investment is embedded into everything that LGPS Central does, and LGPS Central does not support investment managers who do not embed responsible investment into their investment process. That is not the same as exclusions. We're not asking people to exclude certain things from it. What we expect managers to do is to understand all the risks that are involved in the investments they make, to look at those, to effectively evaluate them from a financial perspective, and to decide whether they believe that it's a company that's worth owning or not owning. Page 5 is the products that we currently have or are shortly to launch. So there's a wide variety of products there. Most of the easy, in inverted commas, funds have been launched. Most of the ones that everybody wanted and where there were big savings to be made have been launched. It's really in the private market space that funds continue to be launched, so property and infrastructure along those lines. There are significant savings to be had from joint working in infrastructure and property. They're just more complicated, hence the fact it took longer to get to that launch stage. In terms of the RINE integration, RINE has been, without a shadow of a doubt, the biggest, RINE and ESG, environmental, social and governance, one and the same thing. It's been the biggest growth area in LGPS Central really since inception. And that's because the partner funds want us to focus on that. It's not because we've decided that that's a key thing. We do think it's an absolute key thing to do. But the partner funds are being hit to a certain extent by regulation, the need to report on carbon emissions, etc., within their portfolio. Effectively, they look to us to take the weight off their mind from that perspective, to do the work, do the necessary thing from that perspective. So that's a growing area. And that's because the partner funds want it to be a growing area. It's an area that they want to focus on. In terms of our partnership with Nottinghamshire, and I would be saying exactly the same thing, whether we're at Nottinghamshire or whether we're at Leicestershire or at Shropshire or anywhere else. We have 8 clients. It's absolutely key that we have a good relationship. It's absolutely key that we do exactly what you want us to do, nothing more, nothing less. The stronger that relationship is, the better the lines of communication, the better the outcomes will be for everybody, but most specifically for the pension fund itself, which is really what we're working on. And pooling is all about using the combined purchasing power of the 8 partner funds in combination to get a better outcome. Part of that better outcome is cheaper fees, but it's also having more professional oversight of the managers who are appointed. You know, we have a team at LGPS Central who are experts in their particular fields, who have regular meetings with these investment managers, generally on a monthly basis, to understand what's going on in their portfolios, understand why they are positioned as they are, and to make sure that we're comfortable that they are still the right managers for the products that we have. In terms of a summary, as I say, we are aligned. Ourselves and all the partner funds are aligned. What is good for you is good for us. We do what you want us to do, nothing more, nothing less. We will continue to develop products that Nottinghamshire and other partner funds want. There are a few rules of engagement. The funds that we launch has to be above a certain size, otherwise we can't make the cost savings. If Nottinghamshire comes to us and says, can you launch a £50 million in UK small companies for us? And I said, actually, we can't do it any better than you can do it. There's no savings to be had there. Generally, we would want more than one partner fund to be involved, so the partner funds amongst themselves agree what products they want from us. And our absolute focus is on making sure that the performance of our products is as you expect, and making sure that the cost of achieving that performance is lower than it has been historically. And you'll continue to get those benefits going forward. There is a figure in here. I'll go back a bit. It's on slide 4. The cost savings, it makes it a bit odd that we put cost savings to the year 2033, 34. That's not our decision. That's what the government asked to be produced. On the basis of the funds we have launched so far, the projected cost savings, this is net of the running costs of LGPS Central, for the partner funds will be just over £175 million. That will grow, and that will grow for 2 reasons. One is that investment markets will increase in value, and as they increase in value, your fee savings become more. And the other thing that will increase that is we still have funds that have not been launched that will continue to produce fee savings. So that 178, when we look at it at 2033, 34, will be considerably higher than that. So I'm happy to answer any questions.
Okay. Right, I'm just looking around. Have we got any questions? I think David?
Yes, I've got a couple of questions. What proportion of the Nottinghamshire assets then are invested by LGPS Central?
Table on, it's in the appendix. It's on page, it's actually the last page, last proper page, page 14. So at this moment in time, there's 808 million in public markets and 16 million in private markets. That would be at this moment probably 15% or so, is it, of your assets? However, particularly those private markets, you have made quite sizable commitments to those funds. The way private markets work is you make a commitment and that money gets drawn down over a period of time. So in terms of your actual commitments, it would be substantially higher than that 15% level. It will probably grow with those commitments probably closer to 30%. but there's obviously considerably more assets that could come across in the fullness of time. Okay.
And is the rate of return that you achieve higher than we get on average, which you just have presented in the previous report?
Also in the appendix on page 12 is the performance of the sub-funds that we have launched. And every one of our sub-funds has a performance objective. So the partner funds tell us what it is that they want us to achieve. And we make sure that the risks are commensurate with those returns. Outperformance of markets is actually quite difficult. The reality is that the average investor can only perform in line with the markets because all investors in totality own the market. So the average investor cannot outperform the market. In fact, by the time you took off investment management fees and trading costs, etc., the average investor probably underperforms markets by about 0.5%. That's the reality of the situation. Okay. Yet every active investment manager is expected to outperform. Now, clearly the maths don't work. You can't have every manager outperforming. So outperformance is not easy. The performance objectives that we have been given by the partner funds are relatively challenging. They're certainly not easy, plus 1.5% per annum for global equities. We have not produced performance yet that is in line with that performance objective, but in four of the five funds that we have launched and have reasonable track records, the performance is quite significantly above benchmark, but below the performance objective. The one exception is the emerging market fund, we would have had completely green on this in the last column had it not been for the last day of December where the fund actually underperformed, and as a result we're a basis point behind. So it was a bit annoying that the last day wasn't a better day for us. But so the answer is yes, we have so far achieved performance that is higher than would be expected if you had index funds. So if you achieved the market.
Okay, Colin, thank you.
Okay, all right. Any other questions? I can't see John raising, but I can see. Hopefully, he'll come back on. But I've got just a couple of interesting questions for you. I think one of them is in the presentation about Russia and Ukraine. Could you just explain and just take us through thinking at the moment about that?
Yeah, in terms of, I think it's fair to say, and I've not heard anybody in investment markets say anything to the contrary to this, Russia invading the Ukraine was completely utterly unexpected. It wasn't expected by politicians, it wasn't expected by the investment markets, and hence the fact nobody was positioned for that to happen. Everybody thought it was just posturing. When it did happen, obviously what happened is markets reacted accordingly. Russian assets sold off directly. The fund had the firm holds a number of Russian assets within its emerging markets fund. Thankfully, nothing in the global equity fund. None of the managers were chewed. That was a choice of theirs not to hold it. Not because they expected Russia to invade Ukraine, just they didn't particularly like the companies. They have a wider universe from which to choose, and therefore it's an easier thing for them to avoid. So Russian assets sold off quite substantially. On day one, we were looking at what our fund's exposure to Russia and the Ukraine. The emerging market bond fund has a little exposure to Ukraine as well. We then had conversations with all of the partner funds in combination as to what they expected from us in terms of our reaction to it. Unfortunately, Russian markets then closed on the 28th of February and haven't reopened yet, and I think it's probably fair to say won't be reopening for any point in time. So you effectively can't sell Russian assets at this moment in time. However, we have talked to the partner funds. The partner funds are all of the same opinion, and we are of this opinion. As an investment manager, this is our investment opinion, that it seems highly unlikely that anybody outside Russia will get any value of any note from holding Russian stocks in the foreseeable future. And the foreseeable future goes for years and not weeks and months. As a result, we have made it quite clear to our investment managers, and having discussed it with our investment managers, our thoughts are not in any way, shape or form at odds with theirs, which is as soon as the opportunity arises, we do not expect them to add to their Russian positions, because we think the risk of owning Russian assets, no matter how cheap they are, is just too much. And B, we would expect them, when the opportunity arises, to get rid of those Russian assets. Now, it could be argued that that's a fire sale and you're giving away value to other people, but it seems almost implausible that anybody outside Russia will get any value from those Russian assets going forward. And this is probably in my 35 years or so of involvement in local authority pension funds, this is probably the only obvious occasion over that period of time where moral consciousness and fiduciary responsibility are absolutely aligned. You know, people's morals are different. We could talk about whether you should be invested in oil and gas or tobacco, etc., etc. People's morals will be different from that perspective. But I think the fiduciary element of this and the moral side of this are, for the first time in certainly in my memory, absolutely aligned. So that's the stance that we are taking. We cannot sell at this moment in time. All of those assets have been written down to zero. So that's already come through from an investment performance. That's the stance that the index compilers have taken as well. So we're aligned from that perspective, but that's where we are at this moment in time. And we put out this statement, and I think Nottinghamshire had put its own statement out before that, based on discussions that we were having with them. That was our position, and that is a position that's endorsed by all 8 partner funds.
Thank you. Can I bring in Keith?
Oh, sorry.
Thank you, Chair. Yeah, just to assure the board that the Pension Fund Committee discussed this at length at their meeting last week, and we're having exactly the same discussions with all investment managers, and the views expressed by Colin are consistent with what we're discussing with all of our managers, and that's the approach the Nottinghamshire Pension Fund Committee is taking for all investment. The investment level within Russia is very small. It's less than 0.1% of the pension fund assets. So from a financial point of view, it's a small issue. Obviously, it's as Colin said, one that is very much on our agenda, and very much the committee is addressing it.
Okay, thank you. Right, I've got Mr. Clues. No, not Mr. Clues. Mr. Raisin. Mr. Raisin. I believe you've got some questions.
No, I've got a couple of comments actually. I have to say I was very pleased to hear Colin's presentation. Colin made reference to other pools, and as you know, I'm involved in other appointments with other pools. So I've heard quite a lot of presentations from pools over the time. And I do approach this, you know, as someone who was for 30 odd years a local government officer as well. And it's very pleasing to hear Colin say, and I think I'll quote almost exactly, we focus on the needs and expectations of partner funds, nothing more, nothing less. I think the board should take that comment and put it in its mind and keep it there, because that, I think, summarises what pooling is. You know, it is possible to hear sometimes statements from pools which I think step on the toes and go further than they ought to in terms of what their role is, i.e. stepping into asset allocation and sometimes almost, you know, they run investment. They don't. And I think Colin has summarised that excellently today. And if, you know, LGPS Central, you know, acts exactly as Colin has said today, then, you know, I can see nothing but a positive. But it does clearly need to be, as Colin has said, and that was really, I thought, very positive to hear. So that was just my thought.
Okay. Thank you. I've got just a couple more questions for you. One of the things I mentioned about was shareholders as well, or part of the pool. In terms of the funds that you hold, how much shareholder activism is there on behalf of the pool?
Responsible investment in RINA, responsible, the E stands for engagement. Engagement is absolutely crucial to responsible investment. If you do not engage with companies, you cannot get them to change the way that they operate. Clearly, we want them to change their way of operate because we believe it will enhance their financial value. That's what our key role is, to enhance financial value. But things like climate change and financial issues are not opposed in any way, shape, or form. You know, there's often this debate about whether whether pension funds should be invested in. I'll use oil and gas because it's the easiest one to use. The reality is, if you're not a shareholder in these companies, you cannot influence their behaviour. The world has a long way to go from where we are at this moment in time to net zero. It has a long way to go. That will involve investment of a huge amount of capital. The reality is, the oil and gas industry has the capital with that capital, and it is showing absolutely clear signs when you look at particularly the European-based companies. Not, I think it's fair to say the US oil companies are quite a few years behind from this perspective. But if you look at the amounts of money that BP and Shell and Total and various other European companies are putting into developing alternative energy sources, they recognise that in a world that's heading towards net zero, their future is not based on drilling an oil well and getting oil out and continually doing that ad infinitum, because eventually the well runs dry, and B, the regulators and the governments stop you doing it effectively. So without that capital, it is. So engagement is absolutely key, making sure that companies understand the wishes of shareholders and act in the best interest of shares, the best long-term interest of shareholders, not in the best short-term interests of the chief executive who fancies a nice bonus that year because he can get his profits up by doing something that isn't in the best long-term interest of shareholders.
Thank you. I think, Mark, did you have any questions? No? I've got just a couple more, which I think you'll be very happy with me just giving you a couple more. One of them is actually to do with, and it's on page 4, that you've had 500 plus cyber attacks and that you've been very resilient on that. In terms of cyber attacks, is that information that you'll be giving whatever process you use or company you use? Is that information that you'll be sharing with the other pools, or will it be just?
There is the pools tend to cooperate in lots of different areas. Some of it's quite ad hoc, but there are groups, for example, the legal people get together every now and again, because there are commonalities from a legal perspective that same funds run into. RINE, for example, I'm not aware that there is anything on the IT side of things from that perspective. But the sort of cyber attacks that we face are no different whatsoever to the sort of cyber attacks that any company or any investment company specifically attacks. Once they have knowledge of your existence, they will continue to attack. And thankfully, the systems that we have in place have so far managed to repel them. And we expect that to continue going forward. We have to spend, because we are a regulated entity, we have to be a regulated entity in order to do the business that we have. When I say regulated, that means the Financial Conduct Authority have to be satisfied that we are a fit and proper company to run people's money. So they are no different to that, and we have to make sure that we're up to that and continue to evolve our protection against that. So no, I'm not aware that there is any sharing with other pools, but they will be facing exactly the same things that we're facing.
Okay. Thank you. I think John's got his hand up. Is that a legacy hand or is that a new hand?
Sorry, Chair, that's a legacy hand.
Oh, okay, thank you. And my final two questions are, in the Levelling Up white paper, it asks pools to produce a plan for the use of up to 5% for local projects. How far are you with those plans, and how possible are they, considering the fact that when you mentioned earlier that a fund has got to be a specific size before you can go with it and put it out?
When the Levelling Up white paper came out, which I believe, my dates might be slightly wrong, was the 23rd of February, we called a meeting within LGPS Central where all the investment directors were attending, effectively a brainstorming session. What's been put out there by the government? What can we do, LGPS Central, to assist the potential aims of the individual partner funds? The day after, Russia invaded Ukraine. Now, that didn't stop us doing what we were doing. What we think it probably did stop is we expected partner funds to be coming to us relatively soon after that white paper was issued, asking what we could do, what was possible, what was feasible and what was not feasible. I think Russia's invasion probably stopped that, so it's pushed it back in time. I had a meeting, funny enough, I went to an investment manager in Birmingham yesterday to discuss how feasible the scale of investment in various areas within the Midlands economy was, because it's all well and good the government coming out with an ambition. Firstly, you as the investment committee has to believe that that's going to produce a good enough investment return for the risk that it's willing to accept. also there has to be available investments out there. And I was quite pleased yesterday with the meeting that we have. There are a number of investments, local investments, and when I talk locally, I'm not talking about Nottinghamshire, Cheshire, I'm talking about the whole region, which appear to be very feasible in terms of scaling up if there is the capital there. There isn't the capital there at this moment in time to allow that to happen. So it is something that we are in the very early stages of doing. We think it has to be a private market solution. In other words, investing in companies that happen to be based in the Midlands and are listed on the stock exchange actually does nothing to anybody. Another example we would say is buy an existing property in Nottingham or Leicestershire or Cheshire or Wolverhampton or wherever, actually doesn't do anything, just transfers ownership from one person to another person. There is, however, great scope to use the pension fund's capital and get a decent return on it in terms of assisting developers in funding projects that are required and will produce employment within their regions. That's one area that we scaled up quite quickly because the banks aren't very keen on lending to developers. There are lots of developers who are very good at what they do and just need a bit of capital short term, probably 1 or 2 years just to get the thing built. And we think that's an area that has potential for it. So it's something we're looking at, but it's very early days at this moment in time, and it ultimately depends on the requirements of the pension funds. I wouldn't want you to think that we're spending all day every day doing this because we have our day jobs to do, but we are there to help, and we are thinking about it.
Okay, thank you. Just having a closer look, and I've just got a final question, which is I think I had an earlier word with Keith and was telling me a little bit about how it works. But how often do the pools and yourself get together to kind of work out on what each other's wishes and needs are?
In terms of, there are meetings between ourselves and the partner funds effectively on a fortnightly basis. There are two key meetings that happen. They happen monthly, but they happen to be two different. One's called PAF, Practitioners Advisory Forum, and that's where the partner funds effectively tell us, from a company perspective and from a shareholder perspective, what they expect from us, and we discuss all the things relating to that. The other one is called PAF, IWG Investment Working Group. So that's on the investment side of this. So that's where we talk about what investment products do you want, how the performance is of the products we've got, etc., etc. So there are regular meetings from that respect. In terms of the product pipeline, it's very much as and when we are asked for a fund, we will launch a fund. The partner funds themselves get together and decide what their requirements are. Investment requirements don't change that often. Once you've got a global equity fund, you don't need another global equity fund. But one of the things that is coming close to launch and will be launched in April, and which Nottinghamshire is investing in, is a global sustainable equity fund, where we've appointed 3 different managers, and Nottinghamshire intends to invest in all 3. And these are managers where they invest globally, but they have a particular angle on how they're going to produce excess performance by investing in sustainable companies.
Okay, thank you very much. Right, any further questions? No, I don't think there's any further questions. Thank you very much for your presentation, and thank you very much for answering our questions and so fully. And thank you. So I think the recommendation is for the presentation to be noted. Are we happy with that? Thank you very much. And I believe you're free to leave. So enjoy the rest of the afternoon and make the most of this weather. And a safe journey back. Oh, dear. You're right. Thank you. No, thank you. Right. I suppose formally, with the presentation, can I have a seconder for the noting? I'm just looking at. Okay, right. Thank you, Mark. Got for that. And any members with any questions or comments? No. I think we want next item. Oh, okay. All right. Okay. Right. The next item is where is he? John Raisin with the update advisor to the board, please.
Thank you, Chair. Pages 13 to 21 is my update. This covers a period since September 2021, which was the last update. It covers 5 issues. Firstly, just in terms of the creation of the Department for Levelling Up Housing and Communities, associated with that last September, there was an appointment of a new minister responsible for local government, someone called Kemi Badenoch. I think the interesting thing to note there is the statement the Scheme Advisory Board made on the 6th of October, and he said he expected a changing minister to lead to some delays in the current work stream. As we know, back in September, it indicated been significant delays in the work stream, i.e. lack of consultations, etc. But essentially, as we'll come on to in a minute, there hasn't been too much movement since either, and I think the fact you have a new minister inevitably leads to a delay. So moving on, we've heard reference to the Levelling Up white paper today. This was issued in February. It's a very long white paper. It's 332 pages long. There is a brief reference to the LGPS on pages 162 and 163 of that white paper, and it includes the following statement. The UK government is asking LGPS funds to publish plans for increasing local investment, including setting an ambition for up to 5% of assets invested in projects which support local areas. I think there's a number of important points to make in interpreting this. Firstly, the Scheme Advisory Board, having spoken to the government, has clarified that the use of the word local by the government does not refer to local in terms of fund area, so it doesn't relate to Nottinghamshire or Merseyside or the London Borough of Waltham Forest. It refers to the United Kingdom as a whole. That is the definition of local in the white paper. Secondly, the wording in the white paper, and I think Colin Fatt sort of alluded to this actually, is merely an exhortation. That is all it is, to invest 5% in projects which support the United Kingdom. All that the approach requires is a plan, and that indeed is the only approach the government can realistically take. Because remember, any attempt by the government to directly mandate investment would likely be contrary to fiduciary duty and public law duties, and would almost certainly be challenged in the courts of law. I can think of certain funds, I won't name them, that would take a case, I'm sure. The government will not do that. And of course, fundamentally, LGPS investments, cannot and should not be driven by government exhortation. Rather, they are driven by the circumstances of each LGPS fund, in the light of its many factors, its investment requirements, its funding levels, its actuarial assumptions, its attitude to risk and diversification, consideration of matters such as cash flow and perhaps at the moment particularly inflation and existing allocations. That's what will lead to whether or not funds invest more or not in UK infrastructure or UK housing. To move on to the next one, LGPS consultations. There's been a lack of consultations since the last update in September. In fact, there's been no statement from the government in relation to the 2 big issues that I highlighted last time, which was the Task Force on Climate-Related Disclosure reporting by the LGPS, no consultation on government, despite the fact that was expected a year ago at least, and nothing on pooling. Remember, the government said in writing they would consult during 2021. They haven't. We still await those. There's also been silence on the other major outstanding issues, including, for example, the Good Governance Review, which was sent by the Scheme Advisory Board in early 2021 to the government. I think the latest indication it's got any sort of real provenance is a statement by the Scheme Advisory Board on the 2nd of February, which said and the LGPS issues.
Right, John, you're freezing.
Sorry, can you hear us still, Chair?
Yeah, we can hear you now.
So they expect the Scheme Advisory Board said they expect a consultation may be issued in the summer covering pooling, TCFD reporting and the white paper. If that is achieved, then that would be a huge achievement if it is to get a consultation out as broad as that, given how careful the government will need to be, particularly on the pooling issue. Anything wouldn't come into effect really until April 2023. So I think the earliest we can see anything, further on either pooling or TCFD reporting or good governance is April 2023 at the earliest. Since this paper was written, there has been movement on the Public Services and Judicial Offices Bill. This is the one which will enable the MHCLG then to issue regulations to rectify the McLeod issue, i.e. age discrimination in the LGPS. Since I wrote the paper, the bill, I believe, has gone through all the parliamentary stages, and I looked yesterday and it appears to have received the royal assent. So it would appear it is now an act. If that's the case, then the MHCLG can move towards issuing a consultation, which they've said they'll do, and I think they're probably fairly well advanced in preparing for that, which would then move towards resolving McLeod, which would be a huge issue. Of course, putting the regulations in place is one thing. Including his colleagues around the country will then need to enact that to actually sort out the actual realities in each particular fund. Moving on to the cost control mechanism, I think, as you'll recall from previous presentations by both myself and John Clews, a cost control mechanism was put in place for the public service pension schemes in 2013. And the objectives basically are to protect the taxpayers from unforeseen risks, to maintain the value of pension schemes to members, and to provide stability of benefit levels. So members are clear as to what benefit levels they have. And it's expected that only in extraordinary circumstances would that mechanism be brought into play. Now, recently the government became concerned that the mechanism perhaps wasn't operating as they thought it would operate or mightn't operate. So they asked the government actuary to review it, and he came back with a review in June 2021, and subsequently the government issued a consultation based on the government actuary's suggestions. And basically what they want to do is to amend the cost control mechanism so it is less likely to be triggered. And there's three main changes they've suggested. I think the most important one is to widen what's called the corridor for changes. They put in various assumptions. They look at various projected costs. And if there's the cost of those move by more than 2%, then they can change either the benefit structure or the cost that members pay. They're talking about widening that from 2 to 3% and also changing a couple of other indicators. The Scheme Advisory Board for England and Wales, LGPS Scheme Advisory Board, responded and raised concerns about all three changes. However, on October the 21st, the Treasury came back and said in its response, we intend to implement all these three changes, but they did recognise and acknowledge the LGPS concerns, and they have committed to discussing with stakeholders, and I think that'll be the Scheme Advisory Board in particular, ways to introduce these changes.
Okay. Right. So, John,
Yeah.
you're frozen again.
So, sorry, Jim. Has that come back?
Yeah, you're back.
So I said the Treasury has said they will talk to stakeholders. I think that's particularly the Scheme Advisory Board to seek to ensure that any changes to the cost control mechanism do take account of the LGPS concerns. The final issue I want to talk about is the review of the actuarial valuations of 2019 by the Government Actuaries Department. After the 88, as they then were, funds valuations are done by their individual actuaries, the 4 actuarial firms. The Government Actuaries Department reviews those actuarial valuations against 4 criteria: compliance, consistency, solvency, and long-term cost efficiency. 2 of those, compliance and consistency, look at how the 4 actuarial firms approach the valuations, and 2, solvency and long-term cost efficiency, look at the actual funds, and GAD measure the funds against metrics they've put in place. Essentially, to summarise, GAD found all the valuations were compliant with the relevant regulations, so all the actuaries had carried out all the valuations appropriately. In terms of consistency, the fund actuaries had a consistent dashboard to aid stakeholders comparing results of different funds, but GAD said that differences in methodology and assumption do not allow for like-for-like comparisons. Yes, that's true. But that is never necessarily ever going to be the case, because the 4 actuarial firms use different methodologies, and they also tweak their own methodologies for the circumstances of the individual funds. It's rather like accounting. You know, a different auditor and a different accountant will apply different accounting approaches within the overall guidelines. So I think GAD have been a little bit unrealistic there. You know, comparison is fine, it's helpful, but we mustn't lose the idea that ultimately the valuation is there to meet the needs of the individual funds as opposed to GAD reporting. In terms of solvency, I think a concern GAD had was that the size of pension funds had grown considerably greater than local authority budgets over the 3 years from 2016 to 2019. And therefore they said that if in the future there was a need to increase employer contribution rates, this could put a greater strain on employers. That's their thoughts. In terms of long-term cost efficiency, GAD are very concerned that funds shouldn't, as they say, defer payments too far into the future, i.e. that they shouldn't attempt to recover deficits over too long a period going forward. They also raised the issue of the fact that some funds are transferring assets from councils to funds, for example, housing assets. And while GAD said they didn't comment on the action of any fund, that they raised a concern about this as a general principle and suggested there should be, you know, guidelines. They came up with just 4 recommendations. One was improve consistency in the approach to assessing emerging key issues, one of which was academy conversions. I think the actuaries have gone back a bit on that and said, we're not sure that's necessarily what we would agree with. Secondly, ensuring deficit recovery plans can be demonstrated with continuation of a previous plan, i.e. that deficit recovery plans, you know, are looking to recover deficits rather than just being sort of developed for any other reason. Continued improvements in transparency through this expanded valuation dashboard, and finally, the appropriate governance arrangements around asset transfers so that you do actually achieve long-term cost efficiency. I've referred at the bottom there on page 21 to where you can find the actual section 13 report and the 2 appendices. That's really the presentation, Chair. Happy to answer any questions from members.
Okay, thank you. Any questions on John's report? No, I can't see any indications. So as this item and the reports for information, we'll move directly to the next report, which is from John Clues, which is from the LGPS Governance Conference. John would like to take us through.
Thank you, Chair. Just a couple of points before I start. I did present this report to Pensions Committee the other week. One of the things I must say is that obviously the world's changed since we went to the conference, and 1 or 2 things that were being discussed there have obviously changed, and we've heard a bit today obviously about the investments. So what I'm going to do is just highlight some of the points from the conference that will have an impact on the fund going forward, and we need to be looking and making plans for, and indeed we are doing in some respects going forward. So just as a start off, we were welcomed to the conference by John Fuller, OB. He opened the conference and really sort of raised the main themes of the conference, being administration, governance and compliance. And these are 3 main areas that obviously impact on funds. The first real sort of discussion presentation was presented by a group, and that was really for funds to understand, and it was a presentation, sorry, on how funds could understand the views of members of the schemes, and there was a general discussion about the need for greater engagement, and I think there was a sort of, I wouldn't say selling point, but there was
a company there that were sort of giving examples of how funds might want to engage with members. The next presentation came from the Scheme Advisory Board, and at each of these conferences, the Scheme Advisory Board take quite a prominent position. The Scheme Advisory Board was really trying to highlight the issues that pension administration has actually encountered in dealing with the impact of COVID, and I suspect, and we are still dealing with that, and wanted to highlight growing regulatory compliance for funds. And Councillor Phillips at the time highlighted, obviously we've talked about McLeod and how that's going to impact on funds, and we as a pension fund are planning for that. There was a position of discussion around climate related financial disclosures. I think Keith could probably tell more about that. The exit cap that we reported back in 2019 is coming back on the agenda, and funds and local authorities will need to be looking at that when further information is provided by the government. The regulator single code of practice is going to be high on the agenda when that comes out sometime later this year, and the pension funds are going to have to look at comparing themselves against the new code and making changes as and when required. Obviously, as John has already said, we've got the valuation, and GMP reconciliation is still high on the agenda. The good governance, the Scheme Advisory Board are still pressing that, and we await a response from the government following the consultation on good governance. However, it has been highlighted that funds need to start looking at that, because the recommendations, it is said, may not necessarily change following the consultation, because they have actually been consulted on over time. And then the big issue coming onto the scene is the pensions dashboard. So we've moved on from the Scheme Advisory Board, and there was a discussion presentation around disinvestment, and we had somebody from Friends of the Earth, and I can't remember the actual other person who was on the panel. However, there was a discussion about disinvestment and promoting change. I don't think there was any. I think there was an agreement that disinvestment was being looked at. I think there was just disagreement on how quickly that was happening. The next section was then presented by John Richards, the Assistant General Secretary of Unison, and he talked about how funds had handled the pandemic, along with stating how important he felt pensions administration is, and the need for funds to focus some time on administration. To end day two, there was then a panel session about the valuation, and that was Barry McKay, who is our scheme actuary, was on the panel and really presented very much some of the topics that he presented to Pensions Committee and to the Pensions Board in relation to the valuation. Day two came along, and we started off with an exciting discussion around cyber security. Exciting it is, important is very much is. We are looking at cyber security from a pension fund point of view, and we have engaged some discussion with the scheme actuary on how we might do that. We are, how can I say, cyber secure through through Nottinghamshire. However, the fund needs to have its own cyber security policy, and basically what we're saying is we have got policies that we work with alongside the county council, but really we need to put them into a pension fund box and make sure that pension committee and pension board are aware of what our policies actually are. I hasten to add as well, that is going to be in the pension regulator single code of practice, so it is going to be quite a focus. So we are secure, it's just we need to document that appropriately for the fund. Pension scams was also another highlighted position, and as we know, we've presented to committee and the board about what the pension fund is doing on pension scams. But it was recognised that that pension scams are becoming administration trying to prevent pension scams is becoming quite arduous. We're certainly feeling it in administration in terms of the additional administration that it's taking to review transfers in and out of the fund. We had a discussion at the Pension Managers Group meeting yesterday across the East Midlands, and certainly that was the theme that was coming out from other colleagues in the LGPS. We did have a legal update, and within that legal update as well, there was a further discussion about the single code of practice from the regulator. And as I say, the fund will need to do its own risk assessment against the code. That was really the main items from the conference chair. We did have the conference close with an investment outlook, but as I say, that's changed, and you've heard from the pool. Just as a note, the next conference is in 2023 on the 19th and 20th of January, and we have secured an additional place for a member of the board to attend that meeting. So we'll be coming round in the near future to see who might want to attend. Thank you, Chair.
Thank you very much, John. Any questions? No. All right, Mark.
Thank you for that, Jonathan. You spoke briefly about the exit cap. Is there a date on that when they're going to table it again? And is it still going to keep it at the same limit as 95k, I believe? Oh, sorry.
That's a very good question. I think the answer to that question is I don't know yet. The member from the Department of Levelling Up, who was at our pension officers group meeting, reported yesterday that the government are looking at it again. He didn't give us a date for it, and he certainly didn't mention whether it was going to change from the 95k. We simply don't know, but there are plans in place to put it back on the agenda. So I'm sorry, I can't actually answer the question fully at this stage, but I will report back once the government releases more information on it.
Thank you. All right. Any further questions or inputs? I've got just a couple, which are mainly to do with progress on McLeod. How's that going, and what's going to be the implications on the fund?
Thank you, Chair. As John said, the legislation, I think we received royal assent. I think it was yesterday. The The fund at the moment is still collecting data. We have a project in place, we have a project manager in place, and we are due to interview for a data officer to help with the collection of data. We're interviewing next week. This is the second interview we've held. The first person we appointed turned us down. So we have a plan in place. We are waiting for the government to issue the regulations and the remedy that they're going to propose. So we don't know what the liability is going to be for the fund yet, but I can tell you that there's 29,000 records that need to be reviewed. So it's a fair piece of work, which is going to take a significant amount of time. But that's where we are, and we will obviously report back once we start to progress with the collection of data and we know where we are. But we are still waiting for that remedy from the government.
Thank you. I'm just having a look before I put in my next question. And this one is about the issues from the Scheme Advisory Board. Especially, you talked around disinvestment. I think this might be between yourself and Keith. What is going to be the impact? Because obviously there's going to be a time scale for the disinvestment, and working through that, what's the likely impact? Sorry, Keith, that's putting you.
No, that's fine, Chair. I think Colin put it extremely well in his presentation. So that the fund has no disinvestment policies or proposals. We see engagement as the way to affect change within companies, and the example Colin gave was that if you're not a shareholder, you can't influence what those companies have to do. So from our point of view, it's always been that engagement is the way forward, not disinvestment. We don't see that as an approach that will work. Simply transferring the ownership of a company to someone who may be less concerned about climate change, as an example, is an effective way of managing those companies.
Thank you very much for that. That clears up a lot, because I think with disinvestment and with a lot of, I suppose, groups that are pushing for it, I think what they seem to forget is that there is obviously, it's a long lead-in before that can happen. So thank you for that. And my final one is, what is the impact on the funds of the new regulations for pension transfers?
We're just coming to understand it, really, Chair. The change in the regulations happened in November, and so what we've done as a fund is we've recruited to an additional post to review transfers, and what we're having to do is look at the transfers more fully. We've had a couple of cases where we've had to seek further financial advice on a particular members wishing to transfer their funds out of the fund. We've had a couple seeking to transfer overseas, which has raised some amber flags that we've had to seek again further information, and we've changed our process and are continuing to change our process in line with the requirements of the regulator. So it's early days yet, but it is taking more time from admin to check some of these particular transfer requests. Again, we discussed it at the East Midlands Pension Managers meeting yesterday, and we're, I suppose, working together with other funds, just checking our own processes and making sure that we're reducing the risk of members losing their funds when choosing to transfer out. But early days, and I think we've only had 2 cases so far that's raised concern.
Okay. Thank you very much. Oh, sorry. John?
Yeah, I just wanted to comment on this issue of disinvestment. I mean, what we have to fundamentally remember is that funds are here, to make an investment return, and that's what the statutory guidance to the investment regulation says. And when you see on page 25, someone saying that engagement isn't working, I think the truth is that if you look at what LAP has done over many years, and they've engaged very heavily, and that's their approach, engagement does work. I think we have to be careful that sometimes certain activists, it doesn't matter how much engagement there is, they are not going to listen because they have an aim which is not the aim of the pension fund. The aim of the pension fund is to generate returns to meet members' needs. Now, quite rightly, we should incorporate ESG issues into the investment approach to make sure that they are taken account of, because clearly there are risks if you don't follow, good governance or good, decent social policies or take account of climate change. But they in themselves are not what pension funds should be concerned with. So I think if people think the LGPS is suddenly going to disengage, and the next question, of course, is disengage from what? Because if we all had to write down privately what we would like to invest in and not invest in, I bet my list would be different than David's, or from yours, Chair, or from anyone else in the room. We'd probably end up invested in nothing. So I think we need to be very careful about this. But, I think we do need to remember what the pension fund ultimately is here to do, and that is to pay the pensions of the members.
Thank you very much, John.
Can I make a point?
Yeah, please.
Chair. Just in terms of the report, it does say actually in the report that the presentations were representing the views of the presenters and not necessarily the views of the whole conference. So it's just to point out what was being discussed rather than what was actually, obviously there weren't any decisions made, it was just a point of view.
Thank you very much on that. Right, John, I think is that a legacy hand or you're yellowed out? Oh, okay, thank you. Right, thank you very much for that. And John, thank you very much for your report back. I formally move the recommendations which are on page 29, which is that this report is for noting. Do I have a seconder? Thank you very much, Mark. Suppose we'll now move to the vote. Is that agreed? Thank you very much. Right. The motion has been carried. We shall now move on to item 8, which is Kieran, the report reporting on the fund risk register and the reports. Oh yeah. Oh, okay. Thank you. Do you mind taking us through, John?
Thanks, Chair. Obviously, we bring the risk register to each of the pension board meetings, and it's really for questionings. But I'd just like to pick up on a few of the risks, just to highlight them. And I'll go through some of the governance risks. We've obviously highlighted in the first, and I'm looking at the page 39. Thank you. I'm looking at page 39, and just go through the risk descriptions. So the risk governance 4 around resources, around managing the fund. We'd highlighted that as very high as an inherent risk and high as a current risk. We're still rating that as high as a current risk. However, Pensions Committee did agree additional resources for us in 2021, and we're still trying to recruit to those resources. That is proving quite challenging in terms of we've been through quite a few recruitment processes, and we're finding it very difficult to recruit. We advertised 9 posts just after Christmas, and we appointed a number of internal candidates, but we weren't able to recruit any external candidates, which creates its own challenge. As I said,
Can I just ask a question? Sorry, John, to interrupt.
Yep.
Is that because the salaries being offered aren't attracting anybody? Or is there just nobody in the industry locally?
Well, it's a bit of, but we don't. It's quite difficult. We had a discussion about this at Pension Officers Group, and there was concern across a number of funds about the salaries being offered. But also, I think that's also highlighting that there aren't that many people for some reason, we don't know why, wanting to come into pensions. This was raised and discussed with the representative from the Department of Levelling Up, and they are seriously looking at some of these issues and seeing how things can be addressed in meeting capacity. But it certainly was reported that all funds are struggling to recruit staff into their funds.
I mean, the thing is, looking at it now, it's going to be a medium to long-term solution, isn't it? It's resource you need on the ground immediately, short term.
Absolutely. Obviously, there are very few people out there with local government pensions experience. What we're trying to do is to recruit from payroll and financial experience because you can't really get anybody with local government pension experience. It's very rare. So we're doing our best that we can. We are looking at our recruitment measures and trying to be more flexible in attracting applicants. So we'll be reporting back over the coming months on how successful we've been. In terms of other actual highlighting some of the things, obviously we're coming up to the valuation, and we're just highlighting about scheme employers and on risk admin 4. Again, we've got an inherent risk of very high with it's a medium identified risk where scheme employees may fail to administer the scheme efficiently, leading to disruption to the discharge of the administering authority functions. And this is around data issues. We have reported back to committee and to a pension board about our data improvement plan. Each year as well, we have meetings with scheme employers running up to year end, and we have constant dialogue with them through the year end process. Members will remember that I brought a report back in December in relation to reporting of breaches, and so we will be looking at where scheme employees do breach their requirements, and we'll be reporting them appropriately, as we have done in the past. But clearly, as it's valuation year as well, there's an increased risk of not getting data. Just in terms of the other highlight is around the scheme cyber security, and that is highlighted. I can't find it. We have highlighted cyber security as a risk, and as I said earlier, we will be bringing a report back to pension board and to committee on our cyber security policy. As I said earlier, it is part of the requirements of the pensions regulator, who is becoming very engaged in making sure that funds are meeting their requirements under cyber security. So that's another activity that we'll be bringing back. So they're the main points I wanted to raise as the risk register, but happy to take any questions of any of the risks that are highlighted in the report.
Right. Any questions to John?
Oh yeah.
On his reports? No, it looks like nobody's indicating. So thank you very much for that. And we'll move on to the recommendation, which is that the Nottinghamshire Local Pension Board members consider whether there are any actions they require in relation to the issues contained within the risk strategy report. Have we got any? Nope. I thought that was John raising his hand, but it's just flicking his papers. Right. Okay. Right. So can I have a seconder, please, for the recommendation? Thank you very much, Mark. And David? Shall we? Is that all agreed? I think the vote has been taken. And therefore, we'll move on to item 9, which is the work programme. And I believe, I think that's yourself, John, is it, to take us through the work programme? Okay, thank you.
Sorry, I keep forgetting to push the button, as they say. Just in terms of some of the issues, as I've said earlier, in terms of some of the work, we're going to have obviously the regular update. The cybersecurity is identified, and there is the training plan and risk register for June. I think the main thing that we will need to bring to you, and has been placed on the work programme, is the good governance report, and that will need to be brought to you as the pension board and to pensions committee, and we will bring that as soon as the Department of Levelling Up raise, I suppose, bring back their recommendations, but there is some work that may need to happen prior to that, and I believe it's on the agenda for the next board chairs meeting of the pool. So we have been asked some questions in relation to good governance and what we are doing, and we are responding to those questions for the next chair of boards meeting within the pool. But I think the work plan is as it stands at the moment, and obviously we review it each time it comes to the pension board. If there's anything else that members want us to have a look at, clearly add them. But I think that we've identified the main pieces of work at this point in time.
Thank you. Part of our recommendation is that we'll consider whether there are any amendments required to the work programme. Have we got any amendments or additions to the work programme that members would like to see? No, I can't see any indications. Therefore, I formally move that the work programme recommendation on page 34, and this has been prepared by John Raisin, and asked if there's any amendments, and just giving anybody any last minute chances. Nope. Right, that concludes the business of the board. I'd like to thank all members and officers for their contributions. And Stuart, could you please end the live stream? Thank you very much, everyone.
Thank you, guys.